The tax-efficient retirement plan every earner needs to see. Imagine this, you're a high earner, near retirement with a healthy 401k, investments, and a vision for a dream retirement. Maybe traveling the world, spoiling your grandkids, or just enjoying the freedom you've earned. But then you retire and the tax bill arrives. Tens of thousands of dollars in taxes on your 401k withdrawals, Social Security benefits, even your investment gains, eating away at the nest egg you spent decades building. A recent study from the Tax Policy Center shows that high-income retirees can lose 20 to 30% of their retirement income to taxes if they don't plan strategically. That's hundreds of thousands of dollars gone. Money you could have used for your lifestyle, legacy, or just peace of mind. The good news, wealthy retirees don't fall into this trap. They use tax-efficient strategies to keep more of their hard-earned wealth, and today I'm revealing the exact plan they follow, a step-by-step blueprint every high earner needs to protect their environment. Stick with me, because this could save you a fortune. Hi, I'm Josh Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. For nearly 20 years, I've guided high-income professionals, executives, and retirees to build retirement plans that deliver confidence, security, and freedom. One of the mistakes I see, high earners assuming their taxes will drop in retirement only to be blindsided by required minimum distributions, Social Security taxes, and capital gains that push them then into a higher tax bracket than they were when they were working. It's a costly oversight, but it's not your fault. The tax code is complex, and generic advice doesn't cut it for high earners like you. In this video, I'm breaking down the tax-efficient retirement plan wealthy retirees use to minimize taxes and maximize their income. I'll share 7 proven strategies from smart account choices to tax-savvy withdrawals that can save you thousands and protect your retirement dreams. Whether you're 5 years from retirement or already retired, this is the plan you need to see. Let's dive in and make your retirement as tax smart as your career. For high earners, retirement isn't just about saving enough, it's about keeping what you've earned. Taxes can erode 20 to 30% of your retirement income, especially if you're pulling from 401ks, Social Security, or investments without a plan. Wealthy retirees don't let this happen. They build tax-efficient plans that minimize their tax burden and maximize their lifestyle. Today, I'm sharing 7 proven strategies they use to create a retirement plan that's as tax smart as their careers. Let's dive in and make sure your wealth works for you. Number 1, build tax diversification early. The foundation of a tax-efficient retirement is spreading your savings across different tax brackets. Think of it like diversifying your investments, but for taxes. There are 3 main buckets: tax-deferred accounts like 401ks and traditional IRAs, where you pay taxes on withdrawals. Taxable accounts like brokerage accounts, where gains are taxed at capital gains rates, and tax-free accounts like Roth IRAs, where qualified withdrawals are tax-free. Now, high earners often lean heavily on 401ks because of employer matches and tax deductions, but this could trap them into a high tax bill later due to required minimum distribution, also known as RMDs. Wealthy retirees avoid this by building all 3 buckets early. For example, if you're earning $300,000 a year, you might max out your 401k at $30,500 for 2025, including catch-up contributions if over 50. But that's only 10% of your income. To diversify, you could contribute to a Roth IRA. Or if your income exceeds Roth limits, use a backdoor Roth strategy, where you can contribute to a traditional IRA and then convert it to a Roth. This creates a tax-free pool for retirement, giving you flexibility to manage taxes later. The goal? Balance your savings so you're not overexposed to tax-deferred accounts that spike your taxable income in retirement. Number 2, master Roth conversions. Roth conversions are a game changer for high earners. Here's how they work. You take money from a traditional IRA or 401k, pay taxes on it now, and move it to a Roth IRA, where it grows and is withdrawn tax-free. The best time? Low income years, like early retirement, before Social Security or RMDs kick in, often between ages 60 and 70. For example, say you retire at 62 with minimal income. You could convert $25,000 a year from your traditional IRA to a Roth, paying taxes at the 12% or 22% federal bracket instead of the 32% or higher you might face later when RMDs start at 73. Over 5 years, that's $125,000 in tax-free funds, potentially saving you tens of thousands of dollars in future taxes. The catch? You need to plan carefully to avoid pushing yourself into a higher tax bracket during the conversion. Wealthy retirees map out conversions over multiple years, smoothing their taxable income and shrinking their future RMDs. This strategy is like paying a smaller bill today to avoid a massive one tomorrow. Number 3, optimize Social Security tax planning. Social Security taxes can blindside high earners. Up to 85% of your benefits can be taxable if your provisional income, which is half of your Social Security plus other income like IRA withdrawals, exceeds certain thresholds. For 2025, married couples with provisional income above $44,000 face 85% taxation. For a couple receiving $60,000 in Social Security benefits, that's $51,000 potentially taxed at their regular rate. Wealthy retirees minimize this by keeping their provisional income low. One tactic is delaying Social Security until age 70, which increases your benefit by 8% a year and reduces reliance on taxable withdrawals early in retirement. Another is using tax-free Roth withdrawals to cover expenses, which don't count towards provisional income. For example, a retiree might live on Roth funds from 62 to 70, avoiding Social Security taxes entirely in those years. The Social Security Administration notes that delaying benefits is very rare. Only 4% wait until the age of 70, but wealthy retirees do it to optimize taxes. This requires a plan to bridge those years, but for high earners, it's a smart move. Number 4, use health savings accounts, also known as HSAs. HSAs are a hidden gem for tax-efficient retirement. They're triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses like Medicare premiums or long-term care are tax-free. High earners with high deductible health plans can contribute up to $4,300 for individuals or $8,550 for families in 2025, plus a $1,000 catch-up if you're 55 or older. The key, don't spend your HSA now, invest it for retirement. For example, $5,000 contributed annually from age 50 to 65, growing at 6%, could become $100,000 by retirement, all tax-free for healthcare. Since medical costs average $315,000 per couple in retirement per a 2024 Fidelity study, HSAs are a lifeline for high earners. Wealthy retirees max out HSA, invest them in low-cost funds, and use them to cover rising healthcare costs, reducing the need for taxable withdrawals. This strategy is like building a tax-free healthcare fund that protects your portfolio. 5, implement a bucket strategy. A bucket strategy helps high earners manage taxes and market volatility. It divides your assets into 3 buckets based on when you'll need the money. Bucket 1, cash or short-term reserves, 0 to 2 years, like high-yield savings or money market accounts for immediate expenses. This avoids selling investments during market downturn. Bucket number 2, conservative investments, 3 to 7 years, like bonds or fixed annuities for steady income to refill your cash bucket. Bucket 3, growth assets. This is really 7+ years, like stocks or real estate for long-term growth. For example, a retiree might keep $100,000 in cash for 2 years of expenses, $300,000 in bonds for years 3 to 7, and $500,000 in stocks for later. This structure lets you draw from low tax or tax-free sources first, managing your tax bracket year by year. Wealthy retirees love this because it reduces reliance on taxable IRA withdrawals and protects against sequence of returns risk, where early market losses hurt your portfolio. It's a flexible way to keep taxes low while ensuring income. Number 6, leverage charitable giving. Charitable giving isn't just about impact, it's a tax-smart strategy. Qualified charitable distributions, also known as QCDs, let you direct up to $100,000 per year from your IRA to a charity, satisfying your RMD without increasing your taxable income. For example, if your RMD is $40,000, donating it via QCD means $0 added to your taxable income, potentially saving $10,000 or more in taxes. Another tool is donor advised funds, also known as DAFs. You can bunch several years of giving into 1 year, maximizing your deductions and lowering your adjusted gross income. For instance, donating $50,000 to a DAF in a high income year could drop drop you into a lower tax bracket, saving on taxes now and later. Wealthy retirees plan their giving to align with their values and tax goals, reduces Social Security taxes and Medicare surcharges in the process. This strategy is a win-win for high earners. Number 7, plan with multi-year tax projections. The final strategy is thinking beyond today with multi-year tax projections. Higher earners face complex tax challenges. RMDs, Social Security taxes, capital gains, and state taxes all interact in retirement. Wealthy retirees don't just plan for this year, they look 5, 10, or even 20 years ahead to optimize their tax burden. For example, you might project that your RMDs at age 73 will push you into the 32% tax bracket, taxing $100,000 of income at $32,000. By converting $30,000 to a Roth annually in your 60s, you could cut your RMDs by $200,000, saving $64,000 in taxes over a decade. Or you might delay Social Security to 70 while living on low tax brokerage accounts, keeping your provisional income below the $44,000 threshold for Social Security taxes. These moves require forecasting your income deductions and tax brackets over multiple years. Wealthy retirees regularly review their projections, adjusting for tax law changes or unexpected expenses like healthcare costs. The 2025 tax code is vast and complex. Planning ahead simplifies it. This proactive approach ensures every dollar is optimized, protecting your wealth and lifestyle. If you're a high earner within 5 to 10 years of retirement or already retired, you don't have to let taxes erode your hard-earned wealth. The strategies we covered today can save you thousands, but they work best when tailored to your unique situation. That's where I come in. Book a free consultation with me using the link in the description below. We'll review your income sources, savings, and retirement goals to create a tax-efficient plan that protects your lifestyle and secures your future. Subscribe to my channel for more tips to retire smarter and keep your wealth working for you. Let's make sure your retirement is as tax smart as your career. Book your call now. Thanks for watching and taking the time to plan for a stronger retirement. If this video helped you, please share it with someone who could benefit from these strategies. I'll be back with more ways to protect and grow your wealth in my next video. Until then, stay proactive and let's build a tax-efficient retirement that matches your hard work.